If you've been looking to get into the real estate investing game, do not miss this video. Today we're joined with Jason Dupree, who is a mortgage loan officer at Texana Bank, and they have some great investment products, specifically financing products that are unconventional. They don't go based on your debt to income ratio personally. They don't go based on how much income that you have personally, but of course there are some advantages and disadvantages to this. So without further ado, let's jump into talking with Jason and talking all things investment in real estate. All right, Jason, thanks so much for being here today and talking some financial stuff with us. So today we're kind of talking about how to get into investing in real estate and some of the unconventional ways to finance real estate, because I don't think many people, I don't think they have a ton of cash sitting in their pocket to finance or to pay for their rental properties or whatever they may be doing. So talk to us a little bit about how someone can finance a rental property if they're looking to get into that.
Sure. So nowadays there's two major routes to go when looking at a rental property. The standard conventional investment loan, which has been around forever. In my 15 years plus in the business, we've done a ton of them. Really the guidelines have barely changed over 15 years, which is nice. But on the other hand, Fannie and Freddie, to help bolster first-time home buyers, have actually put in some penalties, which has made rates and pricing much higher than it was in the past. With a lot of the changes that have come around, we've seen other products come about. The big one being a DSCR loan. DSCRs are awesome. They're becoming more and more popular, which has got some added benefits. And really it's becoming kind of more the standard for investment properties. If you're somebody who's looking to buy the beach house or lake house or mountain house, and you're only thinking of one property, you could technically go either way. Not a huge difference. Especially if you're only going to occasionally maybe rent it to friends and family, not so much put it on VRBO or anything like that. You're probably safe no matter which way you want to go. On the other hand, if you're going to be somebody who's looking at this as a business opportunity or a second career, or you're going to be renting it full time, DSCR is probably really the only safe choice out there. And truthfully, I think that most people, either they're going to loan officers that aren't familiar with the product, or there's this fear because it is not as well known that keeps people from looking into it. And we can discuss further, we'll dig in, but you'll see that really there's a ton of advantages with very little downside when we look at these DSCR alternative products that are out there.
Good deal. So sort of talking about DSCR, talk to us about the qualifications on the buyer or the borrower side for, do they look at income? Do they look at assets? Sort of how do they qualify someone for that loan?
Yeah, no, 100%. So first off, DSCR stands for debt service coverage ratio. I know, probably doesn't sound the easiest thing to figure out, but debt is the mortgage, the taxes, the insurance, and the HOA fees. What does it cost you to own that property? Coverage is the rental income. And then the ratio is what percentage of the debt is covered by the rent. So if you've sat through any business classes, this is probably sounding a lot like something you would have just talked about when putting together a business plan, and that's really what this loan is. It is more of a business loan. It is a mortgage, so there is that component of it, but it is really looked at as a business loan versus your standard mortgage product. So what we're looking at that coverage is either a 75%, 100%, 125, or no coverage whatsoever. So the idea being, the higher the rent coverage is of the debt, or the 125 where it actually shows you're going to turn a profit, that's going to have a major impact on the amount of down payment, the interest rate, and the amount of reserves you need to show. So mainly on a DSCR, what we're looking at is that ratio and your credit score to be able to qualify. We don't need 1040s, we don't need personal income. I've got a gentleman right now, we actually were just talking right before we started this. He's a doctor, a surgeon, he owns his own practice, he has 15 different properties, his tax returns look like a novel. So doing a standard loan is just a mountain of paperwork to get that going. So right there, that's one of the big issues where DSCR doesn't matter. All we need to worry about is what this new home looks like and confirm you're not going to be living in it. Standard guidelines, the max loan to value, so the least amount of down payment you can put down to get into one of these products is going to be 15%. What I would tell you, at 15%, you're going to need the 125% coverage, you're going to need great credit. So reasonably more people are looking at 20, 25% down payment. That helps to mitigate the risk. There is no PMI. So if you do only put 15% down, there's not that added PMI cost that you have with your conventional loan programs. And so that's a big part of it. Minimum credit scores, you're going to need at least a 660 to get into one of these products, which truthfully in this day and age, for buying a home, 660 is, well, yes, there are products that go lower than that. It's kind of become the new minimum with where rates are at. Because when you get below that, the extra cost is just, it almost makes it so it's much tougher to do what you're looking for.
So sort of on the real estate side, so I closed a DSCR loan this year. It was my very first one, and I knew nothing about DSCR. So one of the things going into working with that client of mine was he was sort of looking at properties that needed a ton of work because he was told, make money on the buy, put the money into it where you can go and refinance later, maybe a cash out refi or whatever it may be. But sort of what we ran into in the appraisal process was the appraiser wanted a ton of stuff done to the property because they basically wanted it rent ready rather than him having to put the money into it to obviously make money on the buy. So is that sort of how the products work there too? It needs to be rent ready, or what's going on there?
Yeah, in some regards, you are looking for that. So, think of it as if you're buying a business. If you were going to buy a lemonade stand, for instance, if the lemonade stand is operational, okay, that's fine. Now we're going to examine, what's the income look like, what's the location look like for you, all these different factors. But if it's operational and it can make money compared to what you're going to be paying monthly to acquire it and to maintain it, then we're okay, as long as we're close. Now, again, in a situation like that, and it's not uncommon, especially for a savvy investor, you're buying an undervalued asset. So it needs work. These happen a lot when somebody's owned a property for a long, long time. It's been in the family, let's say. Maybe the renter has also been the same renter for 15 years, 5 years, 10 years, something along those lines. And as soon as that renter's out of there, you've got to replace carpets, paint, all the kind of normal upkeep on a rental property. Or it's an area that's really come up. And the previous owner bought it when it was maybe a down area. Something like that would be what they call our no ratio DSCR. It's going to take a larger down payment. The rate is going to be higher, but good news is that can be temporary. The idea being is once you've done the work, you've shown that now it's running more at the top of the market. Now you can go back and refinance that into another DSCR loan. You can even take cash out on the DSCR refinance. So let's say you had to put a larger down payment because the rent perspectives look really bad in the current condition. So you put 30, 40% down, whatever it takes to get it qualified. But then after you fixed it up, you've got new tenants, so we've got leases, we've got all this proof that now we're back towards the top of the market. Great, we turn around, we do the refinance, you could take some of that cash back out of the property, whether you took it maybe out of a 401k, other investment accounts, stock market, wherever that money came from, you can put it right back on there. Another really popular way to get the financing set up for this is doing a HELOC on your current primary residence. So that is one thing on the DSCR. We do have to prove you have a primary residence. Doesn't mean you have to own it, you can rent, but we have to show that you're not going to live in the rental property because it is a rental property. Because if it's not being rented, it can't show income, which defeats the purpose of the loan. But if you've got a primary residence and values, as you know, are higher than they've ever been, and you've got that extra equity, and you want to start having that make more money for you, take that money out in a HELOC, use that as your down payment. The great thing is we don't care about the HELOC payment because the DSCR doesn't care about your other debts. It only cares about that transaction. So it's an awesome way to take that money that's just sitting there. It's not appreciating in value. It's not earning any kind of ROI, and move that over into something that is going to actively make you money, both on a monthly cash flow, but long term, as the more properties you have, as you know, the more your wealth grows.
So all this sounds really, really simple. But, you know, just with real estate and with being a mortgage loan officer, if it was simple, everybody would do it. So talk to us about the disadvantages. I know we talked about sort of rates being a little bit higher. Is that the only disadvantage? Talk to us a little bit about that.
Yeah, so a couple things on that. So the disadvantages were, in the past, the rates for a conventional investment property were much lower. Second homes as well. Second homes, it used to be the second home rate was the same as a primary. Fannie and Freddie almost didn't distinguish a difference. The big difference was between, instead of 5%, you had to be 10% down. But the rate was identical. And if you think about it, that doesn't make a lot of common sense. If I have the house I live in every day and I go buy a house at the beach, if I hit tough financial times, the house I live in, I'm worried about. The house at the beach, what happens, happens. You know what I mean? Like that's one of those things. Well, so now because Fannie and Freddie have changed how they look at those additional properties, those rates have gone up. And because the popularity of the DSCR has grown, competition has brought those rates down. A lot of instances, they're going to be the same, if not cheaper, on a DSCR. Because again, we're looking at it from a more common sense perspective. We're saying, if the rent can cover the cost or make you a profit, that's a great investment. You're not gonna lose something that's making you money.
Right.
You know what I mean? It just doesn't make sense. So that's a big one. And then the boogeyman kind of in the whole idea of DSCR and non-QM lending is prepayment penalties. People hear these and they associate it with stuff that happened pre-crash back before 2010, when there was there wasn't a lot of regulation. Nowadays, a prepayment penalty is very, very minor, and you can choose anywhere from 1 to 6 years. Some states don't allow them, which makes it a little bit harder, but here in the Carolinas, no problem. 1 to 6 years, the longer the prepayment penalty, the lower your interest rate will be. The idea is it's just kind of giving the lender a guarantee that they're going to have a chance to make back the money on the deal. And so with that, whether you're 1 to 6 years, if you sell, refinance, whatever it is, that property in that time, whether it's the first month or the last month, all you do is pay 6 months of interest on the remaining balance of the loan. So for example, you owe $100,000 left on your loan, you're in that prepayment penalty period, you've got an interest rate, let's say, of 7%, the penalty is only $3,500. So you're talking, when you go to sell a property, $3,500 is kind of a blip when you talk about the different taxes and everything else that comes up to sell that property. So the idea is prepayment penalties really shouldn't put anybody to worry. There's really, it's such a minor thing. And again, these are business transactions. The same with the interest rate. If the interest rate's a little bit higher because you put less money down or whatever the factors are, then your rent will reflect that. The idea is your rent is going to cover that. It's not like your personal property where your paycheck is what's covering the cost. It's the rent you're charging. So the idea is you can manipulate those where you may have a property, again, like you talked about, one that needs some work, or what I'd recommend, something that an area you think, work with somebody like Noah who's super knowledgeable. Find an area that hasn't taken off yet, but is next on the list. Go in there with the rents may not be high. Maybe you're just breaking even to start with. That's fine because you're still getting the appreciation of that property. So you're still making long-term money. And then as that area blossoms, you bought in at a lower price point, but now you can start charging those rents go up. Now you start turning a big profit going forward. I'm a little bit south of you, I know, and the Rock Hill market is a big one like that. As Fort Mill expands into Rock Hill, a lot of people did this when they were building a new sports complex in Rock Hill for the Carolina Panthers. That was one of those things. They're building this whole kind of mall area. And so getting in early is a great way to kind of take advantage of some of those ideas and you kind of build up. So that's a big one. And I do want to touch on a couple of the other advantages of the DSCR. Very quickly, the big one is you can close in an LLC. By closing in an LLC, the debt does not get reported to your personal credit. So if something does happen, you have some protection there. The other big one is if you go to buy a new primary residence, that debt is not impacting your ability to qualify for a new home. There is no DTI restrictions. We don't care about your income. So if you're somebody who just lost their job and you're sitting on a pile of cash, this is a way to start showing some monthly income, and we don't care that you don't have a current job that we're seeing because we're worried about, does the property make sense? There's no limit on the amount of properties you can own. So again, if you want to be the next real estate tycoon, great. Start lining them up, knocking them down, not a problem. If you went the conventional method, after 10 properties, Fannie and Freddie won't touch you. They won't let you do anything whatsoever. There's a lot less documentation. If you're somebody, again, as you start to do more and more of these, every time if you get a regular loan, we would need lease agreements, tax returns, HOA documentation, insurance, confirmation of rent checks from bank statements, mortgage statements. You're talking just a pile of documentation. All that's wiped away. Not necessary whatsoever. The rates, again, super comparable where conventional rates are. You can even finance a vacant home without needing a lease. There are a lot of different exceptions you can get as well. There are times where we have gentlemen who had actually had a foreclosure on another property that was started due to an HOA issue. He lived out of country, so we can do foreign nationals. He lived in Canada. He was buying in Michigan. He owned a property there previously. The HOA management company changed. It was during COVID, so communication wasn't the best. He kept paying on auto pay his bill and kept getting an email confirmation that payment was received. A year and a half later, all of a sudden he gets legal paperwork showing that they're going to foreclose on the home, the HOA. And so he said, wait, what's going on? He got it fixed, turned around. Well, that would have killed any other loan out there. Instead, we were able to get an exception because we could show how this was a strong lender, a strong deal, and the company said, you know what, it does make sense, let's go. So there's a little more common sense in the DSCR non-QM world than what we see in our normal banking world. So that's huge. You can do condo tells, non-wardable condos, not something you're going to see locally, but I know your clients in this area, they're looking for a beach house. They're looking for something up in the mountains when it comes to these investment properties a lot of times. Pigeon Forge is a huge area for people in this area to target because of the vacation rentals. You get some of these unique properties that normal loans won't touch, not a problem with DSCR. So that's a huge one. And then one of the great ones too, you can go to a 40-year interest-only option. So the first 10 years are interest-only, get your payment as low as possible. Then it goes, and it stays fixed, the interest rate. Then you go to a normal 30-year repayment. So if you are buying an area that you're waiting for it to come up in value, or you're waiting to put your own sweat into the property to really get those rents up, great way to get in at an inexpensive upfront price. But just because it's interest only, you can pay towards the balance at the same time. So maybe you need 6 months, a year to get the property going, then start making those extra payments. There's no reason to wait if you can do it, but that gives you some flexibility that you're not going to find in your normal loan world.
That's cool. I didn't know that.
And I'm sorry, we forgot to touch rental income. I know we've been talking about it like crazy. So a couple of ways that's determined. If there are leases on the property, we can take that into account. What I would tell you right now, and you can probably attest to this, rent is getting higher and higher. Most people out there can attest to it. So we probably don't want to use old leases because a lease today is going to rent for higher than a lease last year. And especially if it's somebody who's been there for a long time or whatever relationship. So if that's the case, we don't want to touch those. But in the future, as the market maybe starts to level out, sure, that can be taken into account. They can do short-term rental income, long-term rental income, month-to-month rental income. All these are going to be determined by the appraiser. They're going to look on the different sites. They're going to use their research tools and find out what this is renting for on average. Month-to-month is something that's short-term. We're familiar with VRBO, Airbnb, those kind of things. Month-to-month is really taken off with the nursing profession. So a lot of these nurses are going, we have a lot of people now that are looking at hospitals and looking at properties around them and going, hey, let me scoop up some of these 3-bedroom, 4-bedroom, and they're really targeting these traveling nurses that are making lots of money, They want someplace comfortable and safe, and they're going to take care of it because generally they're so tired by the time they get off work, they're just getting home, eating, going to bed kind of thing. So these month-to-month rentals are great in those kind of markets as well. So that's a huge, huge help. And again, these appraisers, they are certified in doing this. This isn't just somebody going, well, VRBO said this, or I saw one landlord that did X. They've got software, a lot of things, and then all this information is put into different systems and then checked electronically. So again, there is an opinion in some of this, but there is a backup as well. So, and so far, I've had one or two that came in a little bit low. We had the realtor help provide documentation of other properties that had higher rental income that maybe weren't taken into account. And we were able to get to a better factor that way as well. So, there is that side that if you see something that the appraiser didn't, we still have a chance to go and try to renegotiate that and get that up as well. And it gives the new landlord a great idea of, here's a base rent that I should be charging, because I've had a professional line this up. Now, it doesn't mean you couldn't get more, but at least you've got a minimum to work with.
All right, so sort of on the investor side, so let's say someone puts the home in an LLC, they're starting to make rental income from it, whether that's 200 or maybe even more. How long do they need to wait before they can they can use that income to qualify for like their personal home or, moving into that home? Because I know on the self-employment side, it's typically 2 years.
Yeah, so that is one of the differences between DSCR and the conventional. So if you do it as a DSCR, it really shows up on your taxes as a business, versus conventional shows up as a rental property. So with that, sometimes we get exceptions, but generally the 2 year is going to be the safest bet. But the idea is the debt isn't going to show up either. So I would say probably in those first 2 years, you're not showing much of a profit anyways.
Right.
So it's kind of negligible because we also don't have to hit you for the debt. A lot of times in that first year, if you went conventional and you went to buy the new home, they're not going to use the full lease rental income anyways, because they're going to factor in what about the vacancy time that they have in between renters. So a lot of times they're only going to use 75% of the rental income. Here, we just eliminate it completely. We don't hit you with the debt. We don't hit you with the income. Now, as you've gotten tax returns showing that you're making money off of it, then you can factor that in to help you with the next purchase. But it really does a great job of negating the negatives. But on the other hand, sometimes you can get some help with it as well when it comes into extra income. But the other great thing is, once you close on one DSCR property, there is no waiting period for the next one. I've got a gentleman doing two at the same time. You can't do that on a convention. All day long, they're going to make you close on the first one before you can ever start the next one. Here, you can do multiples as well. So that's another added benefit that you don't have to wait.
Yeah, all this sounds like a no-brainer. If you have the down payment and you're ready to get into investing, it sounds like, you should do
it. And the other big thing is conventional's not going to allow you to do it for a lower down payment either. So really, down payments are pretty equal. But the difference is, if on a conventional, like we talked about, if you took the money out of your primary residence, you're going to get hit with that debt, making it harder to qualify. So if you've got now an extra $500-$600 you owe on the HELOC because you needed that money for down payment or to help fix up the home, that factors into your ability to buy it. On the DSCR, no factor whatsoever, no issue. But again, I do want to make sure all your listeners know, if they're going to do this, here's the couple steps I would do to get prepared. First of all, it's free, it's easy, it just takes a little time as research. Research the area you're looking at, work with a great realtor that can really help you with that point of it, but look at price points, look at the rental trends, contact some landlords in the area. It doesn't hurt to get some firsthand opinions. Look at, is this a short-term versus long-term rental property? Also, the difference in what a short-term versus a long-term means as a landlord. Look into these different factors. There's great websites you can find that'll help you with putting together a spreadsheet of costs and all those other things. Also look at property tax implications. I've had plenty of borrowers in the Fort Mill area, and that's the closest one of where rental or taxes are higher on rental properties than they are on primary. Sometimes 3, 4, 5 times as high. And some areas they do, and the reason these areas are doing that, one, generate income, but two, is they want to control the amount of rental income in an area because they want more homeowners in the area than they do want to turn it into a rental area. So that's something to look at. Also, the difference in short and long term. Short-term rentals can get you classified under hotel taxes. Loan officer I worked with for a long, long time. He's out of the business now because he owns so many of these properties. He lost all his profits the first year because he didn't do the research. Then in that area, with short-term rentals, he was going to get hit with hotel taxes. And so, again, luckily he didn't lose money, but he didn't make the money he was hoping for. So he had to go and refigure some of his numbers. But again, it's something to look into. These are all things you can find out. Contact the right people, do a little work online, just so you know what you're getting into. And also, don't forget a budget for maintenance. Whether that's long-term rentals, replacing carpet, paint, plumbers coming out, or if you're close enough yourself for clogged toilets, simple jammed garbage disposals, things like that. Even the little easy things. If you're not nearby, somebody's got to go do it. And if it's short-term, somebody's got to get there quickly and do it. So once you've done the research, next, form an LLC. Super easy. You can do it super cheap. Do it online. I would recommend, and again, I'm not a legal expert, just to preface, but when I set up my LLC, I found Wyoming right now has almost all the same protections and standards that some place like Delaware has, which you look, that's where all the big companies want to incorporate is Delaware because of all the protections. But Wyoming was like a fraction of the cost because it's Wyoming. That kind of thing. So that's just one of the ideas, but you can look to create that LLC, and it can be created in any state. So everything's kind of virtual now, just so don't think that if you're in North Carolina or in South Carolina, that's where the LLC has to be formed. But form that LLC. The big thing is it's going to help with the protection. You're going to be a landlord. You don't want to open yourself up for potential risk from tenants. Next, get your EIN number. Get that EIN number from the IRS for the LLC, and then you're going to take that EIN number and start a business bank account. Okay, so you don't want that bank account tied to you personally whatsoever, and you want all the rental checks to go right into that business bank account. So there's a thing called commingling of funds. If I am a landlord and I have an LLC and Noah pays me rent every month, but I deposit that rent check right in my personal bank account, I've now commingled my personal assets with my business assets. And now a really savvy lawyer, if Noah wanted to sue me, could say that they should be able to go after what I personally own as well. Now, no LLC is completely ironclad, but by having that separate bank account, you're just protecting yourself one step further. And then you just transfer the business funds into your personal funds. But the idea is you want them to be deposited in that business bank account. And I wouldn't keep a large balance in there either, just because if something was to happen, you show the business is having little to no cash, so that, again, you're protected. Set up a business email address that you have all correspondence with your tenants to go through that. Again, you don't want your personal email it's not so much the business purposes, but just, again, you want that separate email so you can document things easily if something does happen. And I'd set up a PO box as well in the LLC's name. You don't want a potential angry tenant or something like that knowing exactly where you live. And you want that kind of separated as well. So those are all things you can do ahead of time. These things take maybe a matter of a week, 2 weeks tops, and they can be done at the beginning. So I would start your research right away, but if you want to hold off on the LLC, all those steps, you can do that while in the process of buying the home. Just remember, you're going to need to get on those pretty quickly and not put them off like we all seem to tend to do.
Jason, thanks so much for being here with us and talking through all things investing real estate. If you've been looking to get into the investing game, do it now. Don't start tomorrow. Start today. Go with his recommendation. Go ahead and set up your LLC, start your bank account, and start getting all that ready. And then reach out to your preferred real estate agent and start looking on that side. So real estate agents can look in the MLS, they can find all the different properties that you can potentially have equity in, starting out. So partnering with these people, like a great real estate agent and a mortgage loan officer, can really make all the difference in more money in your pocket. If you have any specific questions, comment them down below, and maybe we'll make another podcast talking with Jason and answering your questions. We'll catch you next time.